Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamwin, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today, we're diving into a fascinating exploration of Ontario's housing market in 2024, as reported by Terranet's latest Market Insight report. Janine, it looks like Toronto's condo market had quite the year, with condos making up over 65% of property transfers. What do you make of this?
It's certainly significant, Steve. The surge in new condo completions with about 15,000 new units ready for occupancy really stands out. It seems like the abundance of new units might be one reason the resale market was so sluggish. People had fresh options to choose from, which could have affected resale activity.
Absolutely, Janine. And while multi-property owners continue to dominate the market, their buying habits are shifting. Most of them own just 2 or 3 properties now, indicating a more cautious approach. It's interesting that new multi-property owners make up a significant chunk of the market, with 70% of transactions from those acquiring their second property.
Yes, and it's fascinating to see how single-party investors are stepping up, isn't it? These investors now account for 20% of all multi-property transactions, and quite a few are paying in cash. Millennials and Gen Xers are leading this charge, particularly in regions like Toronto, York, and Peel.
That's right. And it seems like regions such as Peel and Middlesex are feeling the pressure with a higher volume of power of sale activity, signaling financial stress. Even though power of sale volumes are below the peaks of 2015 and 2016, certain areas are disproportionately affected. It's a reminder that while some investors are thriving, others are struggling.
And let's not forget about the challenges faced by first-time homebuyers. With the median age now at 40, it's clear that affordability is a major hurdle. The average price for a non-condo home in Toronto has surged to $1.3 million, making condos a more accessible option for many. It's a tough road for newcomers to the market.
Indeed, Janine. And with homeowners holding on to properties longer, particularly in Toronto, it seems like many are opting to renovate instead of moving. The average holding period for non-condo properties is now nearly 18 years. This shift aligns with the lack of affordability, as people are finding it more practical to improve their current homes rather than relocate. First National has seen some interesting developments this quarter, Janine. They've experienced a significant rise in residential mortgage funding, continuing their momentum from the last quarter of 2024. However, despite this increase, they haven't seen a corresponding rise in profits. What are your thoughts on why this might be the case?
It seems like the surge in mortgage funding hasn't quite translated to the bottom line due to several factors. First National's revenue growth was tempered by narrower margins and increased expenses. For instance, the net interest margins were compressed, particularly in their asset-backed commercial paper conduits. This has made it challenging for them to fully capitalize on the increased volume of business.
You're right, Janine. Jason Ellis, the president and CEO of First National, mentioned that while they funded 34% more single-family mortgages compared to last year, the margins have been a sticking point. The good news is that Ellis expects this to be a temporary issue, especially with the Bank of Canada's rate cuts potentially lowering funding costs in the near future.
And it's not just the single-family mortgages that are seeing growth. Their commercial segment also posted an 18% increase in originations year over year, driven largely by the demand for insured multi-unit residential housing. This indicates a strong demand for affordable rental housing, even as CMHC tightens its underwriting criteria.
Another interesting point is how renewals have impacted their placement fees. Despite a 22% increase in volumes, a larger share of those came from renewals, which earn lower fees than new originations. However, since renewals don't carry broker commissions, First National enjoyed a wider net spread between placement fees and broker expenses, expanding by 30% year over year.
That's a good point, Steve. It's a strategic advantage. Even though the fees per unit dipped, the overall financial health benefits from reduced broker commissions. Plus, the fact that Alt-A mortgage arrears are declining month over month is another positive sign for First National moving forward.
It is encouraging to see that, especially given the economic uncertainty right now. Despite these challenges, First National remains optimistic about the future. Their single-family mortgage commitments are up significantly, and they're achieving this growth without adjusting their pricing or credit quality.
Absolutely, Steve. The outlook for First National seems promising, with their continued focus on growth in originations and renewals. It shows their resilience in navigating the current market conditions and their strategic foresight in managing expenses and leveraging opportunities.
Our next topic is the current landscape of mortgage rates in Canada, which has been quite dynamic recently. According to Salman Farouqui from the Globe and Mail, fixed mortgage rates dropped to their lowest since 2022 in early April, hitting the 3.7% range for insured 5-year mortgages. However, they've begun to climb again as bond yields have surged following a recent stock market sell-off.
That's right, Steve. It's a reminder of how interconnected the global economy is, isn't it? The fluctuations in trade and the stock market have a direct impact on mortgage rates, affecting so many Canadians who are looking to buy or refinance their homes.
Absolutely, Janine. Prime Minister Mark Carney's recent efforts to stabilize the Canadian economy, especially in negotiations with United States President Donald Trump, could play a crucial role in determining the future of these rates. Bond yields are a major factor in fixed mortgage rates, and any stability he can bring might help ease the volatility.
And for homeowners and potential buyers, the decision between fixed and variable rates is becoming more nuanced. With the margin between these two narrowing, it's important for people to weigh their options carefully. If the Bank of Canada reduces interest rates further, as some economists predict, variable rates might become more attractive.
Good point, Janine. It's essential for borrowers to consider their financial goals and risk tolerance. If the trade uncertainties continue and the Bank of Canada lowers interest rates more than expected, those opting for variable rates could benefit. But it's a gamble and requires careful consideration.
Exactly, Steve. And it's not just about the numbers, it's about what fits best with people's lives and plans. For someone who values stability and predictability, a fixed rate might be more suitable, even if it costs a bit more upfront. Meanwhile, those who can handle some uncertainty might find variable rates appealing if they anticipate further rate cuts.
Indeed, Janine. As always, it's crucial for individuals to consult with financial advisors and mortgage experts to make informed decisions. The landscape is changing rapidly, and staying informed is key to navigating these shifts effectively. Let's dive into the recent article by Craig Wong from the Canadian Press, which discusses the wild market swings we've been experiencing lately and their impact on investors. The uncertainty created by U.S. President Donald Trump's tariff policies has been causing significant volatility in the stock markets. What are your initial thoughts, Janine?
Steve, it's a challenging time for investors, especially with the Dow Jones Industrial Average fluctuating by more than 1,000 points in a single day due to these tariff announcements. It highlights the importance of having a solid financial plan and understanding one's risk tolerance.
Exactly. Gabriel Lalonde, a certified financial planner, emphasizes the importance of keeping money for short-term needs out of the stock market. He suggests using high-interest savings accounts or guaranteed interest certificates instead. It's all about aligning investments with one's time horizon.
Yes, and it makes sense. If you're planning to buy a house or pay for tuition soon, you don't want that money tied up in a volatile market. It's crucial to have a safety net, even if it means lower returns in the short term. It's about having peace of mind and financial security.
And Graham Priest from Blue Shore Financial suggests a diversified portfolio to help manage this volatility. Stocks in consumer staples and utilities can provide some stability, although their returns have lagged behind the tech sector recently. It's about finding that balance.
Diversification is key, Steve. It's like having a well-rounded diet for your finances. Priest also mentions that while gold can be part of a balanced portfolio, it shouldn't be the only holding due to its own volatility. It's about complementing your investments, not relying solely on one asset.
That's a great analogy, Janine. In times of uncertainty, having a diversified portfolio can provide a buffer. Lalonde also highlights the need for a financial plan that can withstand market volatility rather than reacting impulsively to market movements.
Absolutely. It's about having a plan and sticking to it, even when the market gets rocky. A good financial advisor can offer the reassurance needed to stay the course. Sometimes, it's just about having someone to remind you of your goals and the bigger picture.
As we wrap up today's episode, let's take a look at the recent developments in the United States job market, which seem to be defying expectations once again. According to a report by Brett Serby, U.S., job growth has surpassed forecasts for the second month in a row. In April, the Bureau of Labor Statistics reported a gain of 177,000 non-farm payroll positions, which is quite impressive given the current economic climate.
It's certainly a positive sign, Steve, especially when you consider the challenges the global economy is facing right now. The fact that sectors like healthcare, transportation, and financial activities are seeing gains is encouraging. However, it's important to remember that these numbers don't tell the entire story.
That's a fair point, Janine. While the headline figures are strong, there were downward revisions to previous months that trimmed a significant number of jobs. In fact, when you account for those revisions, the net gain is closer to 119,000, which is below the market consensus of 130,000. So, while the growth is there, it's not as robust as it initially appears.
And let's not forget the looming tariff risks. Economists warn that the ripple effects of recent reciprocal tariffs have yet to be fully realized. According to TD's Thomas Feltmate, the employment survey was conducted just weeks after the tariff announcements, so we might not be seeing the full impact just yet.
Exactly, Janine. The uncertainty surrounding these tariffs could complicate the Federal Reserve's path to potential rate cuts. Inflation shocks from tariff-driven price increases are a concern, and as BMO's Scott Anderson points out, the negative sentiment among consumers and businesses hasn't fully materialized in the employment data yet.
It's a tricky situation, Steve. With so much uncertainty, it's crucial for policymakers to tread carefully. Feltmate suggests that if inflation expectations remain stable, we might see some insurance cuts this summer to support the economy. However, it's a delicate balancing act.
Absolutely, Janine. And while markets are pricing in a rate cut for July, as Anderson notes, it's a prediction that hinges on several factors aligning. It's a reminder of how interconnected our economies are and how developments in one country can have ripple effects globally.
It certainly is, Steve. For Canadians, this means keeping a close eye on these developments, as they could influence mortgage rates and economic conditions here. It's a time for cautious optimism and informed decision-making.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.